Archie, my tax advisor says I'm doing everything I can to save on taxes.
Rob, I'm at a loss for words. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast. We're your hosts, certified financial planners Archie Hoxton and Rob Hoxton. And today we're going to revisit one of the financial free lunches we talked about a few episodes back, and that's tax loss harvesting. It's a pretty popular topic right now, really due to some research that was done in 2020 showing real, actual financial benefit coming from the practice of tax loss harvesting. More and more financial advisors are incorporating it into their value proposition. More and more individual investors are seeking that out, and more institutions are offering technology to, assist with successful tax loss harvesting. So we want to kind of clear the air and talk about what is it, why is it useful, and what do you need to know if you're going to take that on?
Archie, I think that if we consider the end goal, and that is to look for ways to improve performance, particularly on a net basis after taxes. So if the idea is to make more money and keep more in your pocket, then this active tax management or tax loss harvesting throughout the year is a great way to do it.
Right. Because one thing that most people overlook, and when you think about costs to investing, people think of expense ratios on mutual funds or exchange traded funds, or commissions, or, brokerage fees. Your number one expense in your investment portfolio in taxable accounts is taxes.
Yep.
Right. It creates a huge drag. So if you can find ways to make that more efficient and save money on your taxes, keep more in your pocket, maximize your after-tax return, that's something worth looking into, right? That's your largest cost. So let's start with kind of what it is. What is tax loss harvesting?
Well, so tax loss harvesting has been around for a long time, just like me. I'm in my 32nd year as a financial planner, and all of these 32 years, almost 32 years, at the end of each year, I would go into clients' portfolios, look for positions where there might be a loss so that I could sell it, harvest the loss, take a deduction against income for tax purposes, or maybe a deduction against realized gains for the year or in prior years. And it was a very sort of manual way of doing it. And it was just by definition not applied consistently throughout the year, right? So there could have, and I'm sure there were instances where investments in taxable accounts went down and then went up, and we didn't take advantage of the part where it was down. So the way it works is, let's say you've got a stock, let's just call it Acme Explosives, and your broker is Wile E. Coyote, of course, and let's say Acme Explosives goes from $100 a share to $50 a share, and you could either just stick with it and allow it to recover and move forward, and receive no tax benefit, or you could go ahead and sell it, receive the tax benefit, take the proceeds, maybe buy something similar to Acme Explosives so that you're not out of the market. And then at the end of the day, once that investment is recovered, you're in the same financial position, but you have this $50 per share loss, which you can use against ordinary income.
Subject to limits.
Subject to limits. If you're married filing jointly, what is it, $3,000 a year?
$3,000. $1,500 if you're single.
$1,500 if you're single, okay. And then you can carry those losses forward in future years as long as you're alive. to offset future gains. And they can be used to offset gains in your securities portfolio. It could be used to offset a gain on a piece of rental property, a lot of things.
Yeah.
Super powerful.
So one thing, an example, an advisor I used to work with in my previous job had a client who part of their retirement plan was to sell their home and downsize. Well, they had had this home for a long, long time, and it had appreciated in value significantly past the capital gain exclusion amounts for personal property, your personal residence. If you're married, you can exclude $500,000 worth of capital gains if it's your primary residence. They had much larger gains. Well, they had been engaging in tax loss harvesting and had built a bank of losses that canceled out the remaining gains. So they were able to sell that house, downsize, which was part of their plan, and they kept all of those proceeds from the sale. They didn't have to pay capital gains tax on any of it because they had implemented tax loss harvesting for a long time. And so that's one way that someone, you typically think, well, you're just kind of, taking a loss and offsetting a gain over here in your investment portfolio. But it can move outside of your investment portfolio. It can work for, if you have a business, personal property, residence, all that kind of rental property. So there are all kinds of interesting ways that you can, use this and save taxes on your overall financial picture.
Yeah, if we think about it, a year like last year, 2022, where, I don't know, what was the S&P 500 down? 15.5% or something like that? I'm not sure exactly, but
Between
something
that
like
and 20.
that. Yeah. So it was down a lot. I ran a report for one of our clients, and this is going to vary for everyone, okay? So this is not in any way a promise. But in this particular scenario, that client's account, what they were doing is they had an S&P 500 direct indexing account where they owned the 500 stocks in the S&P 500. They had an active tax loss harvesting overlay that harvested throughout the year. Their account went down just as the S&P 500 did. But the value, because they're in a top tax bracket, the value of those harvested losses saved them what amounted to 6% of those losses. So let's say the account was down 15, I don't remember exactly, 15, but the value of the losses harvested amounted to 6% of the account value. So they were really only down on a net basis 9% after tax in a down year that was down 15. So the economic benefit of this is great. And it's really hard to accomplish the old-fashioned way where you look at the account every couple of quarters and see, are there any losses I could take? This is an instance in which technology and trading technology makes it possible to do some amazing things.
Yeah. Well, and there was a lot of this research that we talked about in the beginning. There's been a lot of research done, rigorous academic research on the value of tax loss harvesting, and the findings are interesting. In any given year, it's not unrealistic that you might gain an additional 1, 2, or even 3%, or even in a really volatile year, as much as 6% on an after-tax basis once you have harvested all these losses, because those losses can be used to offset gains forever, right? That's one important thing to remember. You can offset some ordinary income, which is, your marginal tax bracket, but you can carry forward those losses to offset, again, ordinary income or capital gains forever. There is no
forever as long as you're living.
As long as you're living.
You can't
they
pass
go
this
away
on
when
to the
you
next
pass
generation.
away.
Right?
Yeah. Exactly. So that's important to mention. But so that value can accumulate over time. But this research was really interesting. It did make a distinction that the years where it's most important are the really volatile years, right? And you get the most value. So like in a year like 2020 or a year like 2022 or like 2008, right? These kinds of years where you see a lot of portfolio losses and you see a lot of volatility, that's where you get the most value. In a really great year in the markets, you're not going to see as much, but you're getting a much better value. Great returns, right?
Right.
You always want to make sure that it's better to pay capital gains taxes because you've had a great year of returns than to fret about not being able to harvest losses.
Right. If it's a year where everything you own goes up in value, there won't be any loss harvesting, right? So that's important to know. And it's also important to say that it's really easy to fixate on taxes. And we should never, a really great friend of mine who's a financial planner in Houston, Texas, always reminds us, in fact, he did so by text just the other day, never let the tax tail wag the investment dog. Never let it happen, because no tax savings is better than investment gains, right?
Right. It's always better to prioritize your investment portfolio and the performance, having the right kinds of investments. So don't go and buy crypto to do tax loss harvesting to save money on taxes, because you might just lose your pants.
Well, you will get losses potentially.
Yeah. Well, you might have losses. You'll harvest them, but that's a different ball game entirely.
Right.
So again, don't let the tax tail wag the investment dog. I like that. That's great. There are some pitfalls that are important to remember. So, like we said, doing this using technology and automation is really great. You're delegating the responsibility to professionals and to programmed, automated systems. If you're going to go about it manually, there are things that you need to know. The number one drawback and pitfall is the wash sale rule. We touched on this in the last episode on free lunches. This is the easiest way to basically waste your efforts. So the wash sale rule, so remember, tax loss harvesting, you're selling a position at a loss and buying back a different position so that you stay invested, but you can keep that loss and use it in the future.
Why wouldn't you just sell a position and then buy it back immediately and take the loss?
Well, that's because the IRS would consider that an abuse of the ability to use losses against capital gains or ordinary income. Because you're just taking the loss to take the loss, and there's been no change in your investment picture.
So they enforce this wash rule, right?
Right. And so what it is if you buy a substantially identical security. So if you sell Acme Explosives and buy Acme Explosives back, or if you sell Acme Explosives and buy an options contract on Acme Explosives or something like that, it's
materially
too
the
close.
same. Yeah,
it's too close. If you did that and then bought, some other explosives company, then that would be okay, right? So it's got to be different enough. So, however, the wash sale rule is all based around a 30-day window. So if you were to wait 30 days and then buy it back, you're okay.
But then you're out of the market potentially for 30 days, and a lot can happen.
Right.
Good and bad, but a lot can happen in 30 days.
Another really important aspect of the rule is it also looks backwards 30 days. So if you just bought more shares of Acme and then sold it for a loss within 30 days, the amount of that you paid for those new shares, whatever. So let's say you bought $100 worth and you sold for a $200 loss. That $100 of that loss is disallowed. You can't take that. You can still take, the other 100 out of the 200 in losses. This is most commonly something that you'll see with mutual funds. If you're owning mutual funds and your automatic reinvestment of dividends and capital gains, you will often see that, if you do tax loss harvesting, part of it will be disallowed because it's maybe every month it's been reinvesting. So that's another thing to watch out for. Of course, as always, watch out for your costs. If you're using really expensive investments, or you're doing this all the time and you're incurring trade costs, that's going to eat away your tax savings.
Or you have redemption fees. There are some funds that have redemption fees that can be 2-3% of the trade. So and that is usually within a 90-day period.
So those are big things to watch out for that will eat away at your savings or prevent you from using the losses altogether. So in summary, this is a really great way to add additional alpha to your portfolio through tax savings, after tax returns. But it's important to watch out for pitfalls. It's important to know when to delegate to a professional and to use automation. But it's something to think about. So if you have questions about this, you want to talk to us, leave us a comment, ask the question. Again, we like to hear from you all, and maybe we'll make an episode out of it later. But like, subscribe, share with your family and friends, and we hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.